57,000. That is the absolutely shocking June payrolls number that just completely missed Wall Street expectations. I mean, it's less than half of what everyone was anticipating, which sets up a really provocative question for all of us. Where in the world do markets go next? And does this force a Fed pivot, or are we looking at a rate hike?
Hello, everyone. Welcome back to AI Market News. Today, we're going to unpack a pretty fascinating market divergence. Based on current market information, we are seeing some seriously conflicting signals across the globe. We've got a historic jobs miss in the U.S., a striking divide between tech and traditional equities, and some extreme currency pressures building up over in Japan. So let's dive right into this explainer and clearly lay out exactly what's driving all these major moves.
Section 1, Jobs Miss and Market Reaction. Let's look at how those June payrolls fell short. The June payrolls report is absolutely the dominant narrative right now. How all of us interpret this week labor print is going to largely dictate market expectations for the rest of the summer. The Bureau of Labor Statistics reported that non-farm payrolls rose by a mere 57,000 in June. That's a massive miss compared to the 115,000 consensus forecast. We also saw the unemployment rate edge lower to 4.2%. So why does this matter so much? Well, simply put, this weaker job growth takes immediate pressure off the Federal Reserve to hike interest rates because it shows the broader economy is naturally starting to slow down on its own. Now notice the context around average hourly earnings here, which actually came in right in line with expectations. This is crucial. Why? Because it means we're avoiding something called a wage spiral. A wage spiral is this macroeconomic phenomenon where higher wages lead to higher consumer prices, which then creates a continuous loop of inflation. Because hourly earnings are staying steady, we know the labor market is cooling off without triggering that spiral effect. Ultimately, that means the Fed isn't forced into any drastic or immediate actions. Moving on to Section 2, the tech sell-off versus the Dow record. We are looking at a seriously divided market right now. As you can see in the chart, the Dow Jones Industrial Average surged 1.14% to reach a fresh all-time high. This rally was largely led by old economy stocks and consumer staples. Basically, investors are finding a lot of comfort right now in companies that traditionally weather a slowing economy with proven resilience. However, the graph shows a very different story for the tech-heavy Nasdaq. It shed 0.8%, with major semiconductor and chip names selling off pretty hard. This sharp contrast between the Dow and the Nasdaq really highlights a deeply divided market that's just trying to find its footing. So what's the fundamental reason behind this divergence? Well, it's a classic sector rotation. That's the movement of investment capital from one industry segment to another. In this specific case, investors are basically taking their substantial profits out of those high-flying AI stocks, and they're rotating that money into traditional value companies that offer a bit more stability during a broader economic slowdown. Adding to that tech pullback, we're seeing a bit of an AI reality check. Based on current market information, we have reports that OpenAI is in talks to sell a 5% stake to the US government, while Meta is out there exploring ways to monetize its excess AI compute capacity. For a lot of AI-exposed equities that are currently sitting at lofty valuations, like 23 times forward earnings, these headlines serve as a real warning. The reality is, those valuations now desperately need actual corporate earnings to catch up to the widespread market hype. Section 3, the Fed and interest rates. It's time for Warsh's first real test. Looking at the interest rate context, as you can see in the chart, the FOMC recently held rates at 3.50 to 3.75%. This actually marks the first major test for the new chair, Kevin Warsh. While the rates were held steady for now, the underlying dot plot still indicates a lean toward a potential rate hike later in 2026, which is definitely keeping bond markets highly sensitive. But here's exactly why the Fed might actually decide to pause instead of hike. Just look at the graph showing energy prices. Things like WTI crude oil have dropped nearly 20% over the last 2 weeks. Even though headline inflation remains high right now, the steep mechanical drop in oil prices is naturally going to pull inflation numbers down by late summer. That essentially buys the central bank some very valuable time. Section 4, let's pivot cross-border to Japan markets and yen weakness. We are efficiently in intervention territory. As you can see in the chart, the dollar-yen exchange rate is climbing rapidly, hitting 162.08 during Tokyo trading hours. This relentless slide in the yen has pushed the currency into a real high-danger zone. fueling intense market speculation that unannounced government intervention by Japanese authorities could honestly happen at any moment. To really understand why the yen continues to weaken so aggressively, we have to talk about the yield differential. This is simply the gap between interest rates in two different countries. Because U.S. rates remain significantly higher than those in Japan, global capital continuously flows out of Japanese markets and right into higher-yielding U.S. assets. That constant flow of money directly devalues the yen in the process. Looking at Japanese equities, the graph shows the Nikkei closed essentially flat. However, the broader Topics index actually hit an all-time high. The underlying mechanism here is remarkably similar to what we're seeing in the U.S. market. Domestic Japanese investors are executing a broad rotation out of technology and moving into financial and auto stocks, which is creating much healthier overall market breadth. Finally, Section 5, the week ahead and our upcoming economic catalysts. Let's walk through the timeline, and please keep in mind all times are in Eastern Time. On July 8th at 2 p.m. ET, we get the highly anticipated FOMC minutes. July 9th brings China's CPI data, followed by key Japanese corporate earnings on the 10th. But the ultimate catalyst we are all waiting for is the U.S. June CPI print on July 14th. That single inflation number is likely going to confirm whether we see a definitive rate hike or a continued steady pause. So, will that upcoming CPI print finally force the Fed's hand? Or are we in for a long, hot summer of market uncertainty? Thanks for watching. Please subscribe and hit the like button. This explainer was automatically generated by NotebookLM AI. AI-generated content may include errors. This explainer does not constitute investment advice. For full details, please check the description below.